Well, hello, everyone. Welcome to a new week in the markets. Welcome to Trading a Smaller Account. This is a class where we are very active traders, and I often kind of try and have a theme. And today I thought, as I was prepping for this class, it's important to understand the thought process a trader goes through. So today we're going to kind of do stream of consciousness in that we're going to talk about how a trader might approach both a new trade and trades they're already in. And I like what Will said in the chat, let's get after it, because we have a lot to get after. I'm back after, the Barb Point 2.0 project where I was gone for 6 weeks, and we've got lots of new trades on. We have some trades that have hit our targets, yeah, we are rolling along. So I'm delighted that you guys are here. We are already, heading for 200 people strong, and Paul gets kudos for being the first one into the chat today, followed by Rocky, and then Marcus and David and APA, and Ree loves to invest in travel. I love the way you think, my friend. And to David and Kevin and Marcus and Will and Josh and the rest of the gang, thank you all for being here and for bringing this class to life by being so participatory in the chat. I'm glad everybody is busy chatting in, because I'm going to have you vote on a few things today. I like to run a semi-democratic class, if you will. If you are not following Mike Fairborn, I have Mike Fairborn with me in the chat today. He's a friend and a fellow coach, understands all these strategies inside and out. So if you've got questions, please quest away. If you're here for the very first time, please feel free to type a greeting into the chat so that we can welcome you to this community where we link arms every Monday and Friday, and we're figuring out this trading stuff together. And if you think I'm not still learning, you are mistaken. I started in 2011 as a client, and I continue to learn new things each and every day, whether I want to or not. Isn't that just life? Please follow us in the land of X. My handle, Barb Armstrong CS, Mike Fairborn CS. If not, you're missing out, my friends. Lots of great information posted on a daily basis there. Know that, just before we get into the thick of things, and we do both stock and options trades in this class, that options carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn, to hone your skills, to become familiar with your trading strategies and how the platform works. There are some nuances and differences. The most significant one for us in this class is that short options will never be assigned early in Paper Money, and that can happen in a live account. Okay, so we're going to do a very quick market overview. Kevin Horner does a brilliant job Monday, every weekday except Tuesdays at the market open. And if you want an in-depth market overview, you'll want to check that out. Mike also does a great class on Wednesdays, an overview of what's going on in the market, and so you can check that out as well. Most of what we do in this class is we're placing new trades, and we're managing the trades we put on in previous classes. So if you are brand new to this, you may want to go back to the archives and do a little bit of binge learning. And you're welcome to do that. Okay, and I will post in the show notes below a link to the archives for this class, and Mike will post in the chat a link as well. Okay, so let's go have a quick look at the markets. We're going to look at the S&P, and Friday it hit a new all-time high. And, today it's like within a stone's throw of it. So it's pretty hard to characterize this trend as anything other than bullish, up 10% year to date. How about the NASDAQ? Kind of more of the same, not hitting a new all-time high in the last week or so, but getting close to it. The Dow hit a new high on Friday. And, today we have an inside day or Harami pattern setting up. And, you can look at that one of two ways. Some traders might tend to see this as this stock still being close to this support level and as a bullish sign. Yeah, this is the art of technical analysis. This is our small caps. That too hit a new, not an all-time high, but if we come back and look at the last 3 years, it's getting close. It's certainly been on a significant uptrend. And then when we look at the volatility index, sitting at 15, that's, in the kind of middle of the range of where it's been. And let's come back to a 1-year chart. It's kind of in the middle of the range of where it's been hanging out a lot, with the exception of what happened in February and March of this year. Okay, so let's start by having a look, and we'll look at some previous trades, and then we're going to go and look at some new trades, and then we're going to come back and look at some more, do a little trade management. So first of all, with long call verticals, our deal is we look at these every day. We look at the good, the bad, and the ugly. We're down 50% on Cisco, so we're going to have a look at that. And we're up 45% on Zoom. Okay, so let's come and have a look at Zoom, because with Zoom, we're up 45%, but when did we place the trade? And do we want to just let it roll? Or do we want to consider taking the money and run? Because this is an unrealized gain, and what the market giveth, the market can taketh away. We put this trade on the 29th of August, which would have been, a week ago Friday. So we've been in this for, 10 days, and we've got a 45% gain. And the candle we have today, is indicating that this uptrend may be ready to take a breather. And so I am going to put a little survey in the chat. We're going to take a poll, and I'm just going to say, Zoom, take the money and run. Cue the Steve Miller Band, yes or no. And our target on these is 50%. So do we take the money and run or no? And so just if you'd participate in the chat, Sunny is saying I'd take the profit. John's saying, take the money and run. Yeah, and I'll go with whatever the majority says. I'm not going to lead you until after the survey is over. Now, Cisco, we're down 50%. Now, this is one where we did 2 trades. Okay. So we did 2 trades. We did a 68 and like both of them have the same top. We did one expiring September 19th and one expiring October 17th. And when we kind of look at this vertical here, we still have 83 cents of value. It's, it's still underwater, but it's not underwater by 50%. Because if I take 84 and I divide that by $1.29, we're down 35%. And on when 35%, we're going to say, well, we're going to kind of wait it out. When we are down more than 50%, so if this is under 45 cents or under 50 cents, we're down more than 50% on this one. So let's come and look at Cisco. And our deal is if we're down more than 50%, we get out. And so here I just left this one. This is 68. This is the strike we bought, but we sold the same strike on both. And we're hitting a support level, so we could wait for it to bounce. But for it to be in the money, it would have to be up above here by a week from Friday. And so because we're under 50%, and our rule is if we're down 50%, we exit on the strike ending September, on the one that expires September 19th, we're going to exit that position and follow our rules. As Bob said, follow your personal trading rules. Okay, so we're going to come to Cisco, and here's the one expiring on the 19th. We'd hope to get out at $1.50. Instead, we're going to now try and manage the damage. And 34 cents a share times 300, that's over $100. We could still lose another $100 on this, $102. So we're going to exit that position. And then we're just going to see how this plays out. So this is our long call vertical. And we're going to exit that one. Okay, so we have 85 so far, an 85% vote for taking the money and running on Zoom. And so we're going to do that. And so with Zoom, what else could, if you voted to wait and said, I wouldn't, I just wait for that extra 8%, you're not wrong to do that. But if in fact it does pull back for a few days, could we then do a wash, rinse, repeat, and maybe just go out a little further? Absolutely. Okay, so we're going to come to Zoom. We wanted to get out at 209. We're getting out at $1.96. So, that's not a 40% return in what, 2 weeks? Not even 2 weeks, not such a terrible deal. Some might say. Long call vertical. Okay, so we're exiting that. So we've sold that. And we've locked in that gain. Now, there was another one in the long call vertical bucket, and that was Apple. And Apple didn't have a sell beside it, but it was up over 50%. And what happened with that was, I think I made a mistake where I meant to do only one contract. So I put in one contract with that 50% target. We bought it on August 25th, it hit the target on the 3rd. And then I noticed we had one that didn't have, an exit beside it. And so we exited that today. And, just to quickly, if you're brand new and you've never walked through this process before, how does this pan out? I'm just bringing up my drawing tool so I can do some quick scribbles here. So we bought this for $290. We sold it for $450. So when you take $450 and we did one contract minus $290, we made how much? $1.60 a share or $160. We call that in this class a base hit. That's in large part what we're aiming for. If we get the occasional grand slam, and we've had a couple of those, that's wonderful, but base hit, our return on risk, well, how much could we have lost? $290. And how much did we make? $160. And so what was our return on risk? That was 55%. And so that's how you do that math. Okay. Okay. Any questions? Okay, so we have just gone over 4 trades that were placed, actually 5 trades that were placed previously. So that's our long call vertical bucket managed. So let's go and look at a new opportunity now. And I had a peek at Amazon. So with Amazon, like many stocks, it's been uptrending since early April. And then we had this period of consolidation, and a lot of things consolidated in August. And then we had this diagonal resistance breakout of a triangle or a pennant pattern. and, you know, a 1-day pullback, and it's moving again to the upside. It's trading at 236.77. So if we're bullish on this, could we kind of bracket it? And we tend with our long call verticals to trade them somewhat, you know, conservatively. And so could we come out here maybe 3 weeks and buy the 235 and sell the 240? So it still has to go up $3.30. But in an average day, this stock can move. The range is almost $5. So that's not a huge stretch, some might argue. Now, you know, if we do this 235, 240, we're going to pay 260 for it. And if our goal is to exit, if we either make 50% or lose 50%, you know, we could lose the entire amount. So we could lose, if we do 2 contracts, $520. If we're okay with that, we're going to come in here, create an opposite order. And if we increase this number by 50%, that would be 390. And you might say, like, why would you do that? Like, why wouldn't you go for the whole $240? Because the most we can make is the difference between the strikes, which is $5 minus what we paid to get in. And so why not go for the whole 240? Why be happy with, you know, $1.30? And it's because you have to stay in often much longer to try and get the whole enchilada. And so we're trying, you know, not to be a greedy guts and to just say, hey, a 50% return is, you know, a pretty solid return for a short term. We'd be in this trade for about 3 weeks. Okay. Okay. Now, what I did in preparing for this class is I decided to bring up the Dow. And so what I did is I just started kind of clicking along. Now we just got out of a trade on Apple. So should we wash, rinse, repeat? Well, it's currently pulling back. And so we may want to wait until that pullback is complete. And so I'm not saying no, but a trader might say, I'm going to wait until the pullback is complete, and then I'll place the new trade. So we're now out of this trade, so we can just kind of clear the drawing set, and we're waiting. When we look at Amgen, it's kind of downtrending, but the overall market is up, so that would be counter trend. And then we came to Amazon. And somebody said, well, why did you decide to do a long call vertical versus a short put vertical? Well, we could do a short put vertical, but if you look at, so it broke out here around the 230 mark. And so if you said, well, if I would do a short put vertical, I'd want it to be below a support level. And this recent low here was 230.78. Could I get enough premium? Good question. So if I come out here 3 weeks and say, well, we've got lots of volume here, lots of volume on the stock. If you know you want to see an example trading plan, go to the trade management mini sessions. We've got a 10-cent bid-ask spread. So check, check, check. It meets all those trading parameters. The next thing is, would we get enough premium to sell a vertical? Well, we get $1.20. Actually, that's not too bad. You know, and what do I mean by that? Well, you know, we want to get, if we're in this for 25 days, we want to get at least a 25% return. $1 on $5 is 25%. So $1.20 divided by 380, probably closer to 30, it's 31%. So we could do a short put vertical on this. And then, so let's go ahead and do that. And then we can compare and contrast them. And what's the advantage of the short put vertical? Well, the short put vertical has the advantage of the stock. It doesn't actually need to go up. It just needs to stay above 230. Okay. And so we're going to put our exit in, and, you know, in our example trading plan, we're saying we want to get out when we've got 80% of our max gain. Now, you know, if we get 50% by Friday, we might say, hey, you know, like, let's take the money and run, like we just did on Zoom. Our target was 50%, but we were at 40 some percent and thought, like, hey, things might be changing. So I'm going to, you know, take this unrealized gain and turn it into a realized gain. So we're going to compare this to our long call vertical that has the same expiration. Okay. So I like your questions. Keep them coming. Okay, so then, you know, I'm kind of clicking along. We're going to talk about Boeing in a minute. Then I got to CVX. So you might say, well, CVX has been uptrending. We had this double bottom pattern, broke out, retested. You know, it's kind of come down. We have this candle pattern indicating it may be, you know, it may have found its support level, but this candle pattern requires confirmation. And what is that confirmation? The confirmation is that we want to see the candle tomorrow to close above the body of today's candle. And we don't have that yet. So if we're trying to be conservative, you know, we may just decide to wait. And so you'd say, okay, I'm going to be patient and disciplined. And gosh darn it, like, being consistent and disciplined, that is not easy sometimes. And then we kind of kept on scrolling through. I got to J&J, and I looked at this and I thought, well, you know, it's been uptrending. We had a recent support level here around this 175. You know, it might be kind of consolidating here. Could we sell a short put vertical at this support level around 175? Well, you know, we could have a look. So if we come out here and say, well, 175, we have to do a $5 wide. That's the only option. 86 cents. Well, I know that's not enough. I need it to be $1 for it to reach 25%. So 86 divided by 414, that's only 20%. And so if we want to get approximately 1% per day in the trade or greater, it doesn't meet our trading requirements. And so it's like, well, tough ganazzos. You may look good, but we're going to wait. And we might wait for it to pull back and bounce. We might wait for a more definitive uptrend to continue. You know, and so we might just decide to wait on that one. Okay, continuing on down. JP Morgan. Well, we're kind of waiting for it to break back above this 300 level, and today it's pulling back, so we're waiting. Coke is going against the general trend of the market. Okay, here we have, you know, Mickey D's. And we had kind of this pullback, a diagonal resistance breakout. I think we placed a trade in another account. And came back, moved up, has come back to this support level. And if you wanted to be more aggressive, you could say, well, I know I'm supposed to wait for confirmation, but you know, I see that we have a support level here, a support level here. It could break it, but I'm going to place a trade anyway. The last time we passed, and you know, you could absolutely pass on that. Or you could say, now what's the advantage of the more aggressive entry? Well, the advantage is that, you know, if you say, well, I want to sell maybe the 310, so it's below this level. If I come here to 310-ish, well, there's no ish, I put in 310, could I get enough premium? So if I come to the trade tab, and if we're coming out, you know, we want to be in that 20 to 50 day range. So 370 to 395, you know, that's an acceptable bid-ask spread. We've got 53 contracts. Sell, vertical. We get $1.50. So is that interesting? Well, that's got to be about 33%, right? 150 divided by 350, more than that. It's 43%. So if we say, well, you know what, that's okay. You know, I'm willing to take this risk based on what I see on the charts. I realize it's a little bit, that it's a little bit of an aggressive entry. Now, how many of these are we going to do? Well, we don't want to risk more than 500. This is 350. So if we did 2 contracts, we'd be risking 700. No can do. So there are some rules, if you have a trading plan, that you can have some flexibility on, like, you know, our 50% target on our long call vertical. And then there are some rules where you kind of draw a line in the sand and you say, I am not breaking this rule, no matter how successful I am. And, you know, one of the times when you should be most concerned is when you've just had 10 or 15 successful trades in a row, because then the voices in your head start saying, like, you know, these position sizing rules are for mere mortals. But, like, let's face it, I'm kind of brilliant at this. And so maybe I should be position sizing a little differently. Yeah, that's when you have 10 trades in a row go wrong. And so this is a position sizing rule. We might risk up to 550, but we're not going to risk 700. And so we're going to go to single order, first trigger sequence. Again, when do we want to buy it back? When we got, you know, about an 80% gain. Like, and again, that's a rule that we might, you know, break with. Okay. So 29 cents, good till canceled, confirm and send, short put vertical. And we're going to put down here that this was a more aggressive entry. Yeah. Yeah, like we have these conversations in our head with ourselves all the time. And one of the things, like, yeah, like, don't believe everything you think. You know, sometimes you have to question your thought process, right? Yeah. Okay, so we've placed a trade on Mickey D's. We've placed 2 trades on Amazon. Let's come back here. Yeah, so we've done 2 trades on Amazon, a trade on Mickey D's. We got out of Zoom, out of, you know, Zoom for a profit, Cisco for a loss, and Apple for a win. Now, somebody's asking, what episode has the rules laid out in them? And this is where I want to encourage you to subscribe to the Trader Talks channel on YouTube, because it gives you access to all these resources for free. And when you first get here, you'll see whatever is currently playing. That's what's on the home screen. But if you come to playlists and you scroll down to trade management mini sessions, is what I've called it, just because I needed a name for it, and click view full playlist. So I'm currently working on a series of short videos on candlestick patterns. These are also in the Getting Started series. And so here's the what is a hammer, and you know that's what we were talking about today, so you may want to watch that. If you haven't watched these videos on the power of compounding, I'd encourage you to not only watch them but share them. But then here's a bunch of example trading plans that you can watch and from which you can build your own framework. Oh, I don't know what I did. I just let me see. I just lost my chat, but let me see if I can bring it back up. Okay. There we go. Okay. So there's one here for long call verticals, and there's one here for short long put verticals. There's also the bearish versions. So we've got short put verticals, we've got long put verticals, we've got long calls with a 1 ATR target. And, you know, I'm continuing to add to these. Okay. So it's trade management mini sessions. And then if you're new to Thinkorswim, there's a whole bunch down here, you know, on how to customize a watch list or chart or the monitor tab, all of that good stuff. Okay. Okay. So I wanted now, you know, we said we kind of go back and forth between new trades and current positions. And so we've gone through our long call verticals. Here is our short put verticals. And the deal with short put verticals is we want to get out if we're either up 50 or up 80%, or if we're down dramatically. And so if we look at these, you know, we're up 10, down 10. We've got two. ANET, we were up this morning over 40 or 50%. ANET. And so here's our trade. We put it on the 3rd, and it's come up. And, you know, so here's the deal with ANET. And we're going to vote on this one also. So we haven't made a lot on ANET, but we just put this trade on Wednesday in the trading price patterns, which I treat as a companion to this. And if it pulls back, you know, we could do a wash, rinse, repeat, or we could say, hey, you know what? I don't want to fiddle with it. You know, I'm pretty cool with where we are. We're well above, you know, our strike is at 130. Let's just let this play out. And then some people might say, well, we're up $60. We're pulling back. I'd hate to see all of this profit disappear and have it go into a loss. I'd like to take the money. And so, you know, I'm feeling a little democratic today. So let's do another survey and say, you know, do you want to lock in this profit, or do you want to wait? Because really we're looking for double the profit that we're at now and a little bit more. So ANET, Arista Networks. And I'm just going to say the same thing. Are we going to take the money, or are we going to wait? And then all of these others, the only other one that's really kind of looking ugly is Boeing. And so let's look at Boeing. Okay, so we put this one on a week ago, Friday, on the 29th. And, you know, when we look at when we put it on, it was probably up on the day, but it's pulled back. But where is it currently sitting? It's basically sitting right on this support level. And so we're seeing here, you know, if you're looking at this as a technician and you say, well, you know, do I stay or do I go? Well, we've got still a series of higher lows. And so we might say, you know what? As long as it doesn't break this support level, we're going to wait it out. Okay. Somebody's saying Boeing just got upgraded to 270. So we can come and look at the news. That's another great piece of information to help you make a more informed decision. So they just raised their price target vertical research to 270, from 242 this morning. And, our strike here is at 230. We want us to stay above that. And so with this one, we're, the other day, Ben was teaching a class and I was in the chat, Ben Watson, and he was saying, Barb says something, I can't remember what, but she says it in a nice Canadian way. And I say, take one hand, take the other hand, and put both of them under your thighs or under your butt and sit on them and wait. Wait for time to do its thing and wait and see if support is working. Okay. And on ANET, so far, we're kind of 50-50, but we're leaning towards let's just wait on ANET. And this is another short vertical. And so with short verticals, we're looking for time to do its thing, right? Yeah, Chris is saying, I say wait on Boeing, and we are going to wait on Boeing. Yeah. And it looks like we may be waiting. Oh, we're hovering. You guys are going in between 50. You're 50-50 on ANET. So if we're 50-50, we're going to wait on ANET. Yeah. And and I've said this before, and Chris, I like that line. One thing we don't want to do is snatch defeat from the jaws of victory, but a common issue that people have, traders have, especially retail traders, is that we tend to take our wins and get out of our wins early, and then we hang on to our losses too long, because that's kind of admitting we made a mistake. And really what we want to do is almost the opposite. We want to admit when we're wrong quickly. Okay, so we have another position here on Baker. And it looks like that's it. Did we get out of Celsius? Okay, so here's Baker. We're up just a smidge, and we have a buy right covered call here. The 47 call. This stock has gone up a little bit in value since we bought it, and so has this call. And that's okay, because our goal with this is if we can get called out at $47, we've made a nice return. We've made a $3 return, on a $44 investment. So, if we look at that, if we got called out and we made 307 on a 43.93 return. Now, it's not through that strike. That would be a 7% return. So let's have a look at Baker. So it's kind of hovering here, isn't it? Yeah. And it looks like it hit all our long call targets. So we got out of that for a profit, and we're just waiting on the other one. So let's come and look at our long call on Baker. And so here was our call. We paid $1.83. We got out for $2.65. So how much did we make on that? Let me bring up my drawing tool. Numbers, I can't just do numbers in, well, I can do numbers in my head, but we're taking this 265, we're subtracting the $1.83. So we made $82 a contract, or 82 cents a share times 200, because we had 2 contracts, which honored our position sizing rules, right? We were risking just under 400. So we made $164 on that, which is what? It's a base hit. And what are base hits? They are a beautiful thing. Apparently, pitching has become such an art. Like I used to say, if you can bat 400, they'll pay you millions of dollars. Apparently, if you can bat 3-5, you're an absolute rock star. So, and what was our return on risk? Because you may look at that, it's $164. Like, that's not flying me to Tahiti and having me drinking something out of a coconut. It's like, yeah, no, but it like this, we started the year at 25K. And so, like, if you had a goal of trying to earn an income and your goal was to make $100 a week, or your goal was to make $200 a week, you just like check, kind of came close to hitting your goal there. So 82, how much could we have lost? We could have lost $1.83, $183 a contract. So that's 82 divided by 183. So that's about 45%, which is just like not too shabby, right? Like we said, base hit. Base hit. Do these always work out? They do not. And with Baker, we were going to compare and contrast, with this buy right. The buy rights by nature sometimes we're in a little bit longer. Yes. AP 514, thanks for doing the math. Yeah. Actually, my dad was a teacher, Trade and Grow. He taught shops, and he taught what in Canada we used to call basic level, kids that were struggling. And so the one thing he hated to see was somebody with tons of brain power that squandered it. So you can imagine if I didn't do my homework, what a hit that was. Yeah, not so much. Yeah. So there's Baker. Oh, and Celsius was the last one I wanted to look at, because Celsius was so we ended up out of that. So that would have hit our stop. So let's go look at it. So we had a stop set at 57.40. And so it must have nicked that on Friday, because it's not, 57, said 57.70. Okay, so we ended up stopped out of that on the 5th. So let's take a look if we come back, because, we've got to come back a ways. And I'm not going to have time in this class, but, we sold a number of covered calls on this and made, basically made out like a bandit on that. And then we came in at 34.53 and out at 57.40. So if we take 57.40 minus 34.53, so let me bring up, this is our last one, and then we'll have to wrap. Okay, so this is 57.40 minus our 34.53. So that was 22.87, or, that came out to $2,287. Now remember, $150 we're saying is a base hit, right? And then we also, we had bought a protective put on that, which we bought back. And then, so this was the 40 call we sold originally. We ended up with a 65 call. And then we sold this call in September for $1.64. We bought it back for 30. So if we take that $1.64 or $164, and then we rolled this June to July, So that was another 21. And then we had sold this 42 call that we rolled. So that was another $1.20. And then we had this 42 call, you know, that we bought back. So that was 116 minus 35. And then the protective put, that was 158 minus 15. So that was 143. So we have to take that off as well. 116 minus 35. Oh, so this was minus 35. Okay. And so just real quick, 164 plus 21 plus 120 plus 116. That's 421 minus 143 and then minus 35. So we would add another, you know, and my math may not be right on, 277.65 to our 2287. So even though we were stopped out, our grand total on this example trade was 25.64.65. So that's like 10% of our starting account value. So this was our, not just a, I'd say this wasn't just a grand slam. This was a grand slam at the bottom of the ninth for, you know, the national championship or the World Series. You know, it was a big deal. Anyway, guys, that's a wrap for today. Please hit like, subscribe to the channel, follow us on X, and I will look forward to seeing you on Tuesday for getting started with technical analysis. Up next, Mr. James Boyd. You won't want to miss it. Take care, everyone. Bye for now.